Who was Steve Sober? So Steve Sober was the chief technical analyst. I met him when he was at Lehman Brothers. Okay, I was interning at Lehman. He came from the Merrill Lynch's historic technical analysis department. There was like 30, 50 of them. There was a whole bunch of them, right? So he was part of that. I got to know him during LTCM. The markets were blowing up. He was the only one who made sense when he went on the trading floor and explained stuff. And he couldn't have been the nicest person when I walked into his office as a kid. And he's like, you got to look at charts. I'm like, what are all those things? And it just spoke to me right away. He also taught me, and this was the number one lesson, I don't know if anybody does this anymore, but to draw your charts by hand. So he taught me the concept of, while we have our rules, you still need to get a feel for the tape. So drawing the charts by hand was important. Now, the funny thing is though, when I came back the following summer with my handwritten charts, right, by hand, like on graph paper, up, open, high, low, close, he yelled at me. He goes, I just had to do it on the Dow index, but I did it on all 30 stocks. But I tell you though, that was a good mistake because from working together, like you have to just constantly get your hands dirty and see it. Yeah. You can't rely on your screens. You can't rely on your AI to tell you what to do. You need to touch and feel your charts and get a sense to what's going on in the market because it is a living and breathing organism.
Hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to our latest episode of the Market Misbehavior podcast. Today, we're catching up again with technical analyst John Kolovos. John is a former colleague of mine. We worked together at Fidelity for a number of years, and it's been awesome to keep in touch with John. John now is the chief technical strategist at Macro Risk Advisors, based in the Boston area. He's also the president of the CMT Association. He also teaches technical analysis at Brandeis University, which is where I taught years ago as an adjunct professor, and he is the latest to take on that position, which was started by the late Charlie Kirkpatrick, who literally was one of the giants in the technical analysis community. Wrote the book that many of us have come to appreciate as a fantastic resource for market technicians. John and I get into a number of different things, really starting off with most of the conversation focused in on current market conditions. We've had a incredibly strong April and May, and then a choppy June. So we start there, talking about the shifts in momentum, dig a bit into John's process of applying momentum indicators. You'll hear about what he calls his Momentum Trifecta, why relative strength is so important for money managers, and how he is coaching his institutional clients to navigate a period of market uncertainty. So please enjoy this interview with John Kolovos of Macro Risk Advisors. John, good to see you again. We last spoke back in January. I feel like the world has changed so much since we last spoke.
It has. In chart years, we've aged quite a bit.
Right? I mean, it's so funny. We were talking in January about risks, about potential rewards, about trends. We've got this conflict in the Middle East that ignites, and all of a sudden I feel like the entire game has changed. And interestingly enough, we're now at a point where, it looks like there's some momentum going to a resolution of that. And now we're all sort of grappling with what comes next. We've got a first Fed meeting for the new chair that happened this week. All sorts of things to talk about. With all of that as a backdrop, let's talk charts to start. I mean, the S&P 500 and the NASDAQ are not too far off of new all-time highs, but the momentum feels like it's definitely shifted here from April and May, which were sort of like straight up and to the right, to June, which is more of a choppy, sloppy, sideways phase. What do you make of that transition, and how does that sort of inform your thinking going forward?
Yeah, that's a great way to tee it up, right? So trends are positive, but we're noticing that momentum's starting to change a little bit. So the way that I tend to frame it is that when you start to see momentum, divergences, or just a slowing rate of ascent into the market, it just means the trend is just getting more mature. That's all it really means to me. It doesn't necessarily mean that the trend is fully matured and now has to roll over. It just means that we've left the gate super aggressively, and now we need to kind of just be more mindful of maybe a potential trend reversal, but not necessarily that's the case. So I'm sure the folks who are watching this, and you know this perfectly, is like the only leading indicator that we have in technical analysis are momentum indicators. It's all we have. Think about like trend following by definition is you're going to lag. Okay, you can't be a trend leader, right? With those indicators, most of our indicators that we use are coincidental, right, or lagging. But momentum is the only leading indicator we have via divergence analysis. right? So your RSI is not confirming. I have a model that I use at work, which I call the Momentum Trifecta. You've probably seen me talk about this, where I take the momentum of price, momentum of volume, and the momentum of breadth, and they all have to be on the same page to give either a buy or sell signal. And it's been whipping around the last couple of weeks. And
Sure.
when I see whipping around in terms of momentum indicators, it means that the trend is starting to slow, and that we could be entering perhaps more of a range boundy market, okay, or not. But that's a good way to lead it. The character of the market is changing very subtly, but doesn't mean that we're in a downtrend.
Talk to me more about I'm glad you reminded me of the Momentum Trifecta. And I should note, you and I spoke after your presentation at the CMT event in Boston.
Oh
I think
yeah,
that was last month, right, in May.
it was last
Um,
month. What I do? I did what, 60 charts in like
you
60
you
minutes.
went through, I think, a world record of charts within one present. I mean, it was an aggressive amount of charts.
My head still hurts. I
It
feel
was
sorry
a
for people
vomiting
there.
of charts, but
Yeah,
it was awesome. And what was cool is you hit on so many different things, and it kind of created this really interesting narrative about
hmm,
thinking about all the different pieces of evidence. And
yeah,
something like the momentum trifecta comes to
yeah.
mind as, one of the good takeaways from that. Talk to me a little bit more for those that are less familiar, the momentum in particular, right? So back in April and May for the S&P 500, like the RSI is overbought, like we keep going higher. The
Yeah.
momentum is very, very strong. All of a sudden, the momentum nowhere near the higher range of that. What does that momentum shift particularly represent and tell you about the character of the markets?
So if you're referring to when we were coming out of the V bottom, right?
Yeah.
So there are such things called as good overbought conditions, right? So when
Yeah.
you come out of an oversold and you're still in an uptrend, or not even, right? Even coming out of bear markets, right? That first overbought condition, particularly not a 70 R, let's say hypothetically, right? You get an 80, which is very hard to do
Yeah.
mathematically. Let's say you get an 80 RSI coming out of a bottom. That's a sign of strength, right? That's a good overbought condition. What the market in this particular case was that we not only had strong rates of change, we had breadth thrust, so the internals of the market spiked. So I remember going on air on CNBC, I think a couple of days off the low, we got that spike, and I said, "Hey, technical green shoots have sprouted," and I listed all of them, and that's enough to get the market up to all-time highs. And then the back test that I did on this, and I'll explain this a little bit, is that V bottoms tend to persist. Like, you don't get your first major pullback until about 6 weeks afterwards. And that's when we just had that shakeout about a week ago, right? So you almost have to ignore that first overbought. Now we're in a normal regime when now you need to pay a little bit more attention to the right overbought is actually kind of overbought, and oversolds are going to be oversold.
Yeah.
So that makes sense. And it works the other way around too. You've seen that when you go into a downtrend, that initial oversold doesn't mean you should be buying it. That's a
That's
bad
right.
oversold, right? And you
That's
want to
right.
stay away from it and let the market fix it. It's almost like the indicators. You do this long enough time, you know that the indicators they go from one regime to the next, and then you just then you use them. So now we're in a point where you can kind of rely on those oscillators a little bit better.
I often talk to people about sort of like a phased approach to RSI. Think about these different regimes, right? So we're sort of in the lower range or in the upper range, and the S&P over the last like 12 months has been almost perfect at just showing you, strong move like in mid to late last year, RSI generally higher, and then super neutral as we topped out in December, January, February, kind of lower into the low in March, and then right back up where it needs to be now.
Right.
So the momentum channel again.
Yeah, remember, and if you want to just kind of peel the onion a little bit back and just kind of really get into the momentum discussion for a bit, is like, well, just pull up a chart of any of the DRAM stocks or any of the semi stocks. Like, if you sold the first overbought condition back in April, you would have left. I don't know what percent of, like, almost 100% gain, from there. Now those momentum indicators are normalizing a little bit here. They may be a little bit more helpful in terms of buying the pullback.
Yep.
Right? Not necessarily selling the overbought. It's when you want to be buying those dips a little bit better.
So as this sort of regime change has started to happen in terms of the momentum shifting, right? As we talked about, let's talk a little bit about leadership. There's this whole group of stocks you mentioned, like the DRAM names, right? There's sort of the general trend in the SMH and other semiconductor ETFs remains incredibly robust through all these sort of market, shifts of uncertainty. It just remains strong. How do you sort of, what's your take on that space now as a trend follower? And then how do you respond to the argument that many are making, I think, which are just, these things have gone up for so long, they're way overdue for a pullback. So I don't want to chase it. How do you balance trend following with chasing performance, which it feels like you'd be doing here?
Yeah, all right, from a textbook standpoint, right? Let's say from an analyst standpoint versus a practitioner standpoint. From an analyst standpoint, a trend is a trend is a trend is a trend, right? So it doesn't matter what it is. It doesn't matter what security it is. So trend followers, what we love, we love right tail events, which are awesome returns, fantastic returns. So it doesn't matter in that regard. So it's very cavalier to say, I don't care that it's up. Now, when I talk to clients, it's a different thing because folks are very benchmarked oriented and how they get judged. So to say to somebody, put your entire portfolio in these 4 stocks, that's a whole different game. Another bit of a part of the equation here. So I think they go up. I think they're good. They're leadership. They're secular winners. This is different than the bubble of the late 90s. These companies are actually have earnings. It's not just touching one sector, it's bleeding into other sectors. So it's more healthy. Are there speculative pockets out there that worry me a lot? Yes. And we should talk about that in a minute, right? But like overall, you need to enhance that trend. So as I tell my clients who are all institutional portfolio managers, which is this, you have within your portfolio, you have 2 portfolios you need to manage. You need to manage your technology and your AI portfolio, which is completely separate from everything else. So these are your core leaders. And these are always your core leaders forever. And everything else is a satellite around those core positions. And you're going to have, everything else is going to be tactical over time. I think it's the best. I think it's the only way you can really handle it right now. Jeff DeGraff did a CMT video a couple weeks ago, and he said something fantastic. This is like something to the effect, I'm going to butcher this, but it was something like, you can't call the top. So if you're going to shoot them, you can't shoot them you have to shoot them in the back, right? Once they peak, they come down, then you have to shoot them in the back. There's no way you're going to shoot them when they're running towards you. They're coming too fast. You're going to miss. You have to wait for them to roll over and to get them. Now, the rolling over part, that's the hard issue. And most of my clients, they're less concerned about that than anything else. They're more worried about, what if things do broaden out? Are they too concentrated? I think is what they're ultimately.
So I know there's really good points in there, John. I'm glad you mentioned Jeff DeGraff's presentation. I saw that as well. It was really well done.
Yeah.
Talk to me a little bit more about concentration, because this is something that's come up in another number of conversations, right? And you and I, in our time working together at a large buy-side institution, spent a lot of time thinking about benchmarks and what a portfolio manager is trying to do and the challenges with their particular benchmark. The S&P, I would remember portfolio managers years ago telling me the S&P is a really tough benchmark to beat for a number of reasons.
Yeah.
But I feel like it's gotten tougher, particularly with the over concentration in tech, right? With technology being 40%. And if you group the other kind of tech-like things that are in consumer and everything, it's probably half of the benchmark. What is that sort of current state of the benchmark and the concentration in large cap growth? How, what does that mean as a portfolio manager trying to outperform? Like, what's the secret sauce? How do you coach clients?
I don't know. You tell me. You tell me. No, you tell me. I mean, I could tell you what I advise, whether or not they're doing it or not. It's a whole nother thing. But I'm a bit of a relative strength person. So, you can do trend following on your relative performance lines. And these folks where Dave and I used to work together, they were judged off of the relative line. So 2/3 of my analysis goes on to the trend of the relative strength line. Okay. The price is more for timing and see if there's support and resistance levels and stuff like that. But really, if it's in a relative uptrend, I'm like, you have to. And the bigger it is in terms of their benchmark, you really have to. Okay. So I'm not making recommendations here, but you need to, if you're an EM portfolio manager, you have to be long SK Hynix and you have to be long Taiwan Semi. You have to. Yeah. Okay. Here in the States, you have to be long NVIDIA to a certain extent, right? You have to do that. But you also need to be mindful of your SanDisks and your Western Digitals. So how do I handle the concentration for them? Well, it's twofold, right? There's some folks who are on the right side, and there's really not much to do with that, right? They want to manage their win. I have one particular client. He told me in February he's having his best year ever by February. okay, which is a really good problem to have. So the exercise I do with him is he wants to protect this 1 year number because that's going to improve his 3 and 5. Okay.
Sure.
So that's the game the portfolio managers play. So what I help him with is I use momentum as the volume for to how exposed you should be. So trend tells me to be overweight a group. All right. So semis are outperforming. That's the trend. But what about the momentum of it? And if momentum is firing on all cylinders, then you can turn it up to 10 or 11, like Spinal Tap, right? But if momentum starts to falter a little bit, then you can bring her down a little. But you're not underweight until the relative trend breaks. So at current state right now in the market, I think momentum is actually getting better again for those names. So you're almost at 11 once again on that, which is kind of weird because we only corrected for like a week.
Yeah.
So that's how I'm helping him. Now, the other folks are those who are not concentrated enough yet, and they need to. So the beautiful thing about how this is all working right now, we have two markets, one that's all AI halo, and the other one that is dependent upon the economy, like actual real economic fundamentals. That part of the market is dependent on the dollar, on oil, and interest rates. Okay. So if the market is to roll over, which I think it will, at least this summer swoon, it's going to be very volatile and all that stuff. It's going to happen because of a macro event. It's going to happen off of a macro event. So let's say the market, if I'm right and the market does sell off, they're going to outperform during that sell off because they're not concentrated. And as we're selling off, I want them to be buying those concentrated stocks again. You see? So that's what I'm going to try and do. So as the average stock starts to outperform during a pullback, which it will, which is counterintuitive, but it will, I then want them to get out of those and become more concentrated.
Yeah. So this is a challenge, right? I mean, if you missed parts of that trade, that concentrated, the areas of the market doing so well, I mean, you're in a huge performance hole, but that makes a ton of sense. And I'm glad that you mentioned relative strength. I promise I didn't lead the witness on that one. But you offered it up as expected, like a boss. That 100% agree with that. I think that's the key. So you alluded to some of sort of like the real economy measurements, right? And let's go through a couple of these if we could. When you and I spoke back in January, I remember I looked at my notes. I remember you mentioned the dollar being an important thing to watch.
Oh, it's huge.
As we're going this week, the dollar, index pushing above 100, and that's where it's topped out a bunch of times over the last, 8 to 10 months. What do you make of the stronger dollar here? And what does it mean it's like we've had a number of, sort of push-ups, but never really breaking out. If the dollar does break out, like what does that mean in terms of market conditions and expectations?
Yes. So Dixie above 105.5 counts to 106-ish, right? And then what that means from just a chart standpoint, and that was my view, that was my worry at the beginning of this year, that it would have to do a significant retracement of its bear market. And that means for risk, it would be bearish for risk. It would be bearish. It would be a headwind for risk. It would be stocks would underperform. Now, while we haven't gotten the breakout yet, which I think we will get the breakout, I thought we were going to get it earlier. But what's been helpful, even when you're in your range and your momentum, right? When momentum turns positive, it tends to be risk off. When momentum turns negative, it tends to be risk on. And now if we get this breakout, my worry is it's a coiled spring and it's just going to go pop. Okay.
Yeah.
And you go pop, then I think most stocks are going to roll over. It's going to be a mess. Now, when I peel back the onion, I look at the euro looks very heavy. Look at the Canadian dollar. That looks like that wants to move. Australian dollar also going wrong way. There's even the renminbi that's extended to the downside. That should revert. The yen is starting to break out above 160. That's starting to look like 168. So that should be risk off E. And what will bring that higher, or I don't know who's leading who, it doesn't matter in my world, it's going to bring interest rates with it. So that's the thing. So higher interest rates are going to be an issue. So I mean, to me, what happened with Warsh yesterday, and again, this week, is that I think folks are thinking there's going to be inflation in the system going forward. I don't see that with break evens and whatnot. I don't think that's necessarily the issue. I think the issue is the uncertainty that this new Fed is bringing to the market with no forward guidance and about 100 different task force that people are like, oh, I don't get it. So that created a massive spike yesterday on the short end of the curve. Now, while the long end of the curve has rolled over, that's different, but it's starting to make the curves flatten. And I'm going through a rabbit hole right now, so tell me to shut up. But when you start flattening the yield curve, if you just cover the ticker on the yield curve, you know what you're looking at. You did pattern analysis, you're trend following on it. It actually implies that the 210s curve should invert again, turn negative.
Yeah.
Okay. And that's very bearish for risk. So I'm tying it all together for you as a dollar breakout brings up interest rates and flattens the curve. That in theory is bad for cyclicals, which is the 495 other stocks that make up the S&P 500. There you go. That one, because it's a mess.
Yeah, but you're right, and I feel like a lot of the macro indicators, as long as they're kind of safe, like the dollar's been relatively flat, the 10-year's been choppy but relatively flat in a lot of ways, right? I mean, it's sort of been grinding higher, but it's not really been spiking, and it's been pulling back here a little bit. And so I feel like for a lot of investors, they may have been just ignoring that whole thing, just assuming it's going to be fine. And in one of those sort of macro forces are fine until they're not, right? And I feel like we might be at one of those points where a breakout starts to mean something.
Could be. And what's bizarre is like what I always try to remind folks, and I think maybe a good little lesson is that like you have headlines, right? You have a new Fed, you had this meeting yesterday, right? His first presser, all that, a lot of volatility, but did it change the prevailing trend? Did it change the prevailing trend? And I would say it did not change the prevailing trend yet. And that's what we really need to be focused on so you need to see a lower low develop in the 10-year. So the uptrend so far this year on the 10-year is still positive.
Yeah.
It's just that we need to change that trajectory. But now you look at the short end, like the 2-year, that broke out of a massive base, like massive, huge bottom formation. That thing counts a lot higher. Again, did it overshoot yesterday? Yeah, probably. Does it need to back and fill a little bit? Yeah, probably. But until there's a reversal in trend, everything else is noise.
You had alluded to, sort of the summer doldrums, the seasonality, right? The sell in May, go away, general approach where the markets have often taken a rougher turn in sort of this June, July, August, sort of September range. And then we often have had a major low in the fall, right? In sort of the September, October timeframe. How does seasonality here fit into, where do you weigh that in terms of, oh my gosh, we're at the seasonally weakest part of the year, we need to be out, getting cash, versus it's a non-issue? Where are you at on that spectrum of importance, and how does it sort of relate to these other things we've talked about?
That's an awesome question, because it's not only the weakest part of the year, it's the weakest part of the 4-year cycle right now.
Yeah.
Right. So you have the presidential cycle, right? And the presidential cycle says we should have a major correction, if not a bear market at some point, but you're supposed to buy those hand over fist, because it creates the 4-year oversold condition. That means that year 3, which is next year, is going to be fantastic, right? So you want to be opportunistic with it. So that's the framework that we're in, and we're supposed to start rolling over right around now-ish, late May, early June, but we're already now in the middle part of June. How am I using it? It bothers me. It's like it's squeaking, it's chirping at me. But when it comes to seasonality, what I've learned over time is you have to play it consistently. You can't just ignore it. It's like, oh, not this year. I know I'm not supposed to make gambling, analogies, but like if you play blackjack, you have to follow the rules consistently. Once you start deviating, that's when the house starts to win. So when it comes to seasonality, you need to always just follow the rules and say, okay, this should be a bearish part of the year. So as I said in my my presentation up in Boston, is how do I use seasonality in general? It's this way. When I see strength during seasonal weak periods, I raise a question mark about it. Like I'm a little bit skeptical about it. So like right now, we're strong into seasonal weak period. I'm not sure how sustainable that's going to be. Conversely, if we're weak into a seasonal strong period, I'm more inclined to want to buy that pullback. It sets the condition essentially for it. So yeah, my short version of that answer is we're in a seasonal weak period, and I'm seeing strength, which makes me question the advance if it's going to be sustainable or not.
Yeah, and I'm glad you alluded to the 4-year cycle as well, the midterm election year, because each of those 4 years has a bit of a different shape, and the midterm election year often has a very specific structure to it. You'd mentioned buying the dip, so I'll go to this point next then. What do you make of energy stocks, right? Crude oil just starting to break down. Obviously, the news out of the Middle East implying, things are really starting to improve. Strait of Hormuz now open for business in big time air quotes. Crude oil prices rolling down, not
pretty
surprising.
hard.
Energy stocks, obviously starting to feel the weight as well. For a lot of, I'm sure for a lot of people looking at those think, all right, breakdown, this might be the time to get into energy because they're finally coming off of it. What do you make of that move? And from a technical perspective, how do you sort of think of this pullback that we've seen in oil and energy?
So it's a legit breakdown. Short answer is my best guess is from the charts. We're probably split the difference between 60 and 70 on WTI is my guess. I get there in a couple different ways. That's why I'm saying split the difference between those two. So that's my first end of it. Now, bigger picture, and I probably talked about it back in January, because that's where I was a bit cautious and I thought that oil was going to rip at the beginning of the year, and it did. Yeah. Why? Because it's a secular advance. I'm a secular bull in all commodities, and in particularly oil. So I think what oil is doing right now is just correcting within a secular uptrend. I don't necessarily think this is it. This is the peak for the next couple of years. This is the peak for now. But it's a hell of a volatile one for sure. And what does that mean for energy stocks? There's a very loose, I don't call it loose. The relative performance of the energy sector ebbs and flows with oil. So as oil goes down, energy is going to underperform. So, and you go through a lot of them, again, not a recommendation, but if you pull up a chart of like Exxon, that's a scary looking top pattern that it went through. It's gonna need to work through it, basically. And so if anything, it's oversold, but it's a bad oversold. Go back to what we were talking about before.
Yeah.
Oversold, you're going to get a little bit of a snapback, but you'll probably get another leg lower. And then you want to look for the divergences. You want to call them the false lows, right? You make a lower low and you let your RSI start to diverge. We haven't even had the bounce yet to start looking for that.
Yeah. No, and I'm glad it's so interesting with momentum. I find that's a really interesting way of differentiating between, I don't want to say a good breakdown, but a breakdown that makes you really concerned versus one that just feels more of like a pullback. And the differences in momentum can often describe that. Continuing that sort of thinking to precious metals, gold and silver, both of those obviously have been trending lower here. Gold was, it's silver probably without argument, one of the best trades of 2025. Q1 started very, very well, and now both of those have started to roll over. Gold below its 200-day moving average. How do you think about gold here? Is it an opportunity, or is there something you would need to see on the chart in a downtrend to start to look more interesting to you?
Yeah. So how I'm framing gold is, for short answers, I'm bearish on gold here right now. Tactically, I'm bearish. One, just the wiggles and the squiggles and the lines of it, they just don't look right to me. I think what gold is doing, it's tracing out an ABC correction, and I'm thinking maybe we'll have a 36 handle on it before it's done. That's what I'm counting it to.
Yeah.
If you take a step back on gold, there's and I'm looking at the active contract, there's a good support somewhere around the 40-25 area. That would be a neckline for head and shoulders top formation. So that would be even more bearish if that were to happen, but I'm thinking 36. Now, the confirming evidence for that would be that real rates are going up, right? So there's an inverse relationship between gold and real rates. So I think real rates are trending higher, and until they start to break down or roll over, then I think gold is going to work down. Silver's also struggling here. Palladium already completed its head and shoulders top. So yeah, I'm bearish on those. Now, handing it off to the industrial metals, though, I think copper's fine. Aluminum hit a target near the all-time highs, at least the London one. Needs to pull back a little bit, but telling a different story. So when it comes to the whole commodity stuff, you got to look at those that are telling a story about the economy, and those that are telling a story about inflation, and those that are telling a story about interest rates, right? So I'm more bullish on the base metals than I am, let's say, the precious metals.
John, a number of times as we've talked about charts, you've alluded to a target, right? Some sort of objective, and you mentioned something like it measures to XYZ. You don't have to give us the whole secret sauce, but like what's your general approach to coming up with a projection? Is it based on the height of the pattern? Is it based on some sort of specific methodology?
I just go like this.
It's the pick a number strategy.
I pick a number. Yeah, that's interesting how I do it. Let's see. Yeah, you have how much time do you have? And hopefully your viewers have enough coffee. But I'll try to give you the short answer. It's a blend between what we learned in our textbooks through Edwards and McGee,
Mm.
right? You take the distance, you do your measured move techniques, okay, that sort of stuff. Even yesterday's video that you did, you plugged Edwards and McGee. You have to.
Yep.
That's our Bible.
Classic.
So those sort of things. You take the distance, you flip it. That's step one. Then step two is I do like to use like Fibonacci extensions and whatnot. So I do use more Elliott Wave as I've gotten older and jaded, is that I'll do these extension targets. And then if the, let's call like a 61.8 extension or even like a 38.2, if they start lining up with where the pattern is projected to, I'm really, really confident in that once, like really, really confident. So I try to marry the two, extension targets and the measured moves from your patterns. And then if those happen to line up with actual spots on the chart, oh, forget about it. Like those become like the home run of where I think the thing is going to go to. Anyways, yeah, that's kind of how I do it. The measured move technique with some extensions from Elliott Wave. That's basically how I do it.
Yeah. All right. You channeled the great Edwards and McGee with their classic textbook, Technical Analysis of Stock Trends. And I believe I remember you mentioning reading that one with some regularity. I'm curious for people just starting to learn this toolkit, are there go-to, and not necessarily technical, could be non-technical, are there any sort of books that you find are your go-to review regularly, just so I reinforce these messages?
Well, this is one of them for sure.
Oh, the William O'Neill, How to Make
Right?
Money
You
in
have to do
Stocks.
that.
Classic.
By the way, I was very lucky. I got his signature in there.
Get out of town.
Yeah, I'm cool.
That's awesome.
And that is very good. You have to take the CMT curriculum, obviously.
Which you
And by the way, I'm president, so yeah, you should sit for. But the other one would be, you have to read this in terms of understanding psychology in the market.
Adaptive Markets by Andrew Lowe, right?
And then I actually, this is probably the only real theory I would say that drives the markets. Markets are not efficient. Markets are not random.
Adaptive.
He pretty much nails that there.
Yep.
This one, if you want to get into like building portfolios, and it's pretty easy. This is from Al. This is really good. Stocks on the move.
Yep.
He actually talks about how to use momentum and to build actual portfolios on stuff. And hopefully people heard me when I walked away from the microphone. And then the other one would be, I don't know if this is still in front. This might not help anybody, but this is the first. This was
Fosbeck, Norman Fosbeck.
This was the second book that I got. And I got this from my original mentor, which was Steve Shobin.
Yeah.
So he gave this to me when I was starting, and then he even signed his name in there as well. And I even have his letterhead from the Merrill Lynch days in here too as a bookmark. But this was a really, really helpful guide for me. And it made some of the stuff in here maybe a little dated at this point. But what was fascinating about this book, it came out in this thing in the 50s or 60s.
Yeah.
They were doing back tests then. It's like, no, doing back tests on indicators is not a new thing. They were doing it back then. So I learned a lot in terms of understanding how indicators behave and putting and trying to think more objective about it and more scientific towards the market. And this really, really helped me a lot. So those are some of my recommendations. You can also do Reminiscences of a Stock Operator. That's a fun one, right? You kind of go through his ups and downs there. Market Wizards is pretty awesome as well, like all the interviews. And then I don't have it behind me, but Mark, I always screw up his last name, Mark Miniveri. His book is Minervini. Yeah.
Yep.
His stuff is just like remarkable.
That's good stuff.
Yeah.
You so it's interesting. On the podcast here, our last I think the last interview we had was Dave Lundgren. Mm-hmm. So I'm sort of going through amazing technicians in the Boston area who I respect and love talking to. So you're part of that group. He also mentioned the Andreas Klenau book. That was another.
Oh, he did.
Came up in that conversation as well.
Yeah, I think Dave and I are fanboys of his. I think we're fanboys of his. He's such a great guy. Yeah,
for sure. You had mentioned Steve Shobin as a mentor of yours. And just to wrap up, I feel like one of our jobs as CMTs, as technical analysts, getting more and more gray in our hair. And I think I've got you beat pretty easily on that front. But as we get older, it's teaching people about mentors of ours that they didn't have a chance to connect with and learn from. Who was Steve Shobin and what did you learn from him?
So Steve was who was Steve Sober? So Steve Sober was the chief technical analyst. I met him when he was at Lehman Brothers. Okay, I was interning at Lehman, so I met him then. He came from the Merrill Lynch's historic technical analysis department. There was like 30, 50 of them. There was a whole bunch of them, right? So he was part of that. He became the head over at Lehman Brothers. I got to know him during LTCM. The markets were blowing up. He was the only one who made sense when he went on the trading floor and explained stuff. And he couldn't have been the nicest person when I walked into his office as a kid. And he's like, you got to look at charts. I'm like, what are all those things? And it just spoke to me right away. And he was a mentor of mine. The first thing he did was he told me to read John Murphy's book. And it was great because it was big font, lots of pictures, perfect for me. But then he also taught me, and this was the number one lesson. I don't know if anybody does this anymore, but to draw your charts by hand. Like he told me, like chart the Dow 30 by hand, so you get a feel for it. So he taught me the concept of, while we have our rules, you still need to get a feel for the tape. So drawing the charts by hand was important. Now the funny thing is though, when I came back the following summer with my handwritten charts, right, by hand, like on graph paper, up open, high, low, close, he yelled at me. He goes, I just had to do it on the Dow index, but I did it on all 30 stocks. So I did a lot of extra work that I didn't have to do. But I tell you though, that was a good mistake because from working together, like you have to just constantly get your hands dirty and see it. Yeah. You can't rely on your screens. You can't rely on your AI to tell you what to do. You need to touch and feel your charts and get a sense to what's going on in the market, because it is a living and breathing organism. So that's what he taught me the most, was that, to get a feel for the tape and to listen to it. My other mentor was Jeff DeGraff. We talked about him earlier. What he taught me was you can apply science to what we do. So we were one of the first ones, maybe next to Ned, were the first ones to actually start to back test technical indicators and to put everything into model. Yeah. And I still use that today, right? So I have my multi-factor model, and I got my two-factor model, which is my left eye and my right eye. So that's kind of how I frame it. So yeah,
I was also kindly strongly encouraged to hand draw charts as I was learning them, and I did that with bar charts and with point and figure charts. And I tell you, I learned a ton about momentum by hand drawing point and figure charts. And when you would feel the break as you're writing it, you're like, oh, this is something new. This is something different.
And that was an Alan Shaw thing and a Luis thing, right? They were all about the point and figures. If that's a lost art, so anybody's watching here, pick up point and figures. Like you'll be a famous technician if you start to, because nobody does it anymore. Nobody does it anymore. That's some really good old school stuff. But
another mentor of mine, Jeff Weiss, who was at Jessup and Lamont for a number of years. If you know Jeff, he cracked me up because I first met him. I was at Bloomberg. And he would just print charts out. I was doing all this stuff on the screen. He's like, no, I just want to print them out and get the ruler and the pencil and start drawing these trends. I'm like, dude, what are you doing?
Yeah.
But then he absolutely crushed me because I was getting so drawn into the little noise and flickering ticks. And he would just draw these long trend lines and be like, we're fine, move on to the next thing. And it reminded me to just be patient and just understand the long-term trends that are at work and not fight them so much.
Yeah, that's right. I don't know how we're doing on time, but like I deal with this with my sales traders. If someone would say, oh, this stock is down 5%. And I'd be like, but what has it done to its trend and its retracement? So a technician's worried about what its impact is to its trend. How much is it retracing it? But the percent change to me doesn't matter that much. It's about what its impact to trend is. And that I'm trying to support your comment is it may be down a lot and painful percentage wise, but it's within the context of the trend.
That's right.
She should be all right. So there goes back to what I was saying earlier. Then you just have to manage that position. Turn down the volume as things are getting a little weak, but it doesn't mean you're out completely.
The context matters for sure. John, this was awesome. This is an awesome mix of market commentary, of just awareness of what's happening, thinking about the technical toolkit and how someone like you applies it with great success, and just some great education about some mentors. We'll include a link to all of those books that we mentioned here. Okay. I've got a trumpet in the background, by the way, and you've got some guitars. So next time we're going to jam.
Could you imagine?
But for now, I say thanks for coming on the show. I appreciate it. We appreciate it.
Thank you for having me, and great to see you.
That's super fun. I mean, John's an awesome analyst. He's really a knowledgeable market practitioner and a fantastic technical strategist. I miss working with guys like John in earlier parts of my career, but it's awesome to keep in touch with him and get his latest thoughts. I'm really glad he was able to talk about Steve Shobin, and I'm trying to make a habit, as unfortunately we've lost some of the great technical analysts. The great John Murphy passed away earlier this year, and for me, it's a reminder that some of our mentors, it's so important to remind, those that come after us, the people that came before us and what we learned from them, so we can, keep their memories and their great contributions alive. So I'm glad that we were able to talk about Steve Shobin. And John mentioned that's from the lineage of the great Merrill Lynch Technical Research Department, which at one point was absolutely huge, the biggest on the street as far as I'm aware. And Bob Farrell was the legendary technical analyst there for a number of years, and so many great technical analysts and investors are sort of from that network of current and former Merrill Lynch and then B of A technical research contributors. So glad we talked about that. Also, a lot of good book recommendations. We'll include links to as many of those as I can remember that we talked about, because we went rapid fire through a bunch of them. But that's always fun to get some suggestions from someone like John. Really appreciate when we talk through sort of the different current market conditions. I try to just tease out some of John's process, which I think is really well defined. When he sort of alluded to how he sort of, has used technical analysis to analyze the charts, but also to build models to really sort of backtest and quantify the things that work and the things that don't. And what I like about someone like John is he has built his investment process now based on things that they've tested and they've found that are helpful. This is something we did, at a Fidelity, right? Is find the things that work and use those more. Find the things that don't work and stop using them. So things that he's talking about are things that he has found have helped him navigate previous market regimes. So that momentum trifecta, I think, is really helpful. Thinking about price, volume, and breadth, and sort of recognizing the message that the markets can provide back to us by analyzing those different momentum conditions and recognizing when those things change. Did not miss, and I hope you didn't as well, when I asked him, sort of about his process, about how you outperform when it feels like it's tough to do so, because the benchmark is challenging, because the market environment, the macro environment seems more uncertain. And he immediately answered with relative strength, which I think is absolutely right? With institutional investors, they're sort of trained to look at relative strength because that's how you're evaluated. That's how your performance is gauged, is how well you are doing versus some benchmark. And so relative strength is kind of central to the language with which you describe market conditions. For individual investors, it's less obvious because we tend to think in individual or in absolute terms, absolute returns. And are we making money or losing money? Relative strength is crucial. This is why we think a lot about things like the relative rotation graphs and relative performance of sectors, but also stocks and ETFs, because I think there's great value there. So I'm really glad that John was able to talk about that. And also, final comment would just be a great illustration of how a technical analyst, also recognizes other things, other macro forces. So he was talking about real interest rates, and he was talking about inflationary pressures in the Fed, and he was talking about the strength of the dollar and the shape of the yield curve and what those could all mean. I think being a great technical analyst and a great technically oriented investor doesn't mean that you ignore all the other stuff. I would argue, if to the contrary, you celebrate the fact that the charts give us a bunch of information, but there are other things happening as well. And the way that you paint a more complete picture of the market environment is about thinking about how charts fit into the overall process. And I think John very eloquently sort of illustrated that relationship. Thanks again to John coming on the show today and joining us from the Boston area from Macro Risk Advisors and sharing some observations with us. By the way, if you want to learn more about how to upgrade your own technical toolkit, how you can make sense of the wiggles and squiggles and come up with some systematic, more disciplined ways to identify opportunities and manage risk, our Market Misbehavior Premium memberships are designed for you. 3 great benefits to the premium membership. First off, we'll teach you all about technical analysis and behavioral finance through our virtual courses. Second, we will keep you informed and aware Improve your market awareness through our weekly flight plan, our monthly chart review, and other members-only reports where we apply our proprietary tools like the market trend model and other things to evaluate market conditions and identify those changes of character. Finally, you'll have full and immediate access to our member community where you can ask questions, you can learn from other like-minded investors, and gain my random thoughts as we navigate these markets together. All of that can be yours today if you go to marketmisbehavior.com/premium. It has all the information you need, and I hope you'll consider becoming a premium member today. That'll do it for today's episode for Market Misbehavior. My name is Dave Keller, reminding you it's always a good time to own good charts. Take care, folks.